Welcome to this explainer, Dostu. Today, we're unpacking a really fascinating pattern in market psychology. Have you ever noticed something, truly strange about how we think as investors? Think back to when assets like silver were incredibly cheap. Literally nobody was talking about it. The news was completely silent and no one seemed to care at all. But the absolute second those silver prices started shooting up and dominating the headlines, suddenly, everyone wanted in. So today, we're going to uncover exactly why chasing that late momentum is pretty much the fastest way to buy at the very top and, unfortunately, lose your hard-earned money.
I mean, be honest. Have you ever bought an asset right before the price just completely crashed? It is incredibly frustrating, isn't it? You finally make that tough decision to jump in, you hit buy, and almost immediately, the market just tanks against you. It honestly feels personal. But hey, I want to validate that frustration for you right now, because it is incredibly common. You are definitely not alone in this. This actually happens because of a very specific, deeply ingrained psychological reaction to late excitement in the market.
So let's jump right into part one, the FOMO trap. We need to identify this invisible enemy that's probably sabotaging your portfolio without you even realizing it.
Our main enemy here is the FOMO trap, the classic fear of missing out. It's this psychological phenomenon where investors completely abandon the concept of value and just blindly chase market momentum. You see this massive late green candle shooting up on a chart, and your brain screams that you're missing out on a brand new gold mine. But here is the brutal truth we have to face. Markets reward early belief, not late excitement. By the time you feel that absolute irresistible urge to jump in just because everyone else is doing it, the smart money, the folks who bought when it was cheap and boring, they're already cashing out and looking for the exit.
Which brings us to part two, Anatomy of Late Excitement. Let's see exactly how this builds up by looking at a real-world example of how a perfectly logical catalyst can trigger an intense, totally emotional overreaction.
Not too long ago, the government made this sudden, massive decision to hike the import duty on gold and silver. They jacked it up from 6% all the way to 15%, and immediately after this announcement, we saw prices absolutely gap up and explode. I mean, it was a huge, highly visible move. A lot of retail investors saw that 15% hike, saw the crazy price spike, and they just rushed in to buy. They were completely convinced that the price was just going to keep going to the moon and never come back down.
But this perfectly illustrates the chronological trap they fell right into. Check this out. On day one, the duty is hiked. By week one, retail is rushing in to buy purely out of FOMO. But fast forward to month one, because India is literally one of the absolute biggest consumers of these precious metals in the world, that incredibly high duty actually started to restrict demand. People just stopped buying because, it was way too expensive. And because that buying slowed down so drastically, international prices dropped. Suddenly, domestic prices followed that international trend right off a cliff, and the people who chased the top in week one, they were left holding a massive painful loss by month two.
And you know what? This exact same trap is set all the time, using emergency news triggers. Think about it. A 16% planned hike in petrol prices triggering massive inflation fears. A sudden geopolitical conflict, like Trump rejecting an Iran proposal. Crazy sudden spikes in logistics costs, or those looming threats of market stagnation. These headlines aren't just news, they are specifically designed to manipulate your emotions. They're crafted to make your very first instinct one of pure panic. And that panic, it causes you to panic sell your assets at the absolute bottom, or panic buy so-called safe assets at the absolute peak of their price. It's a total setup.
Okay, moving on to part three, emotion versus discipline. The absolute crucial takeaway here is that long-lasting wealth is simply not created through these emotional knee-jerk reactions. Building wealth, that requires cold, hard math.
Let's contrast two very different mindsets to really drive this home. First, we have Rahul. Now, Rahul loved the emotional story of his investment. He bought a house, took on a huge loan, and absolutely loved telling everyone at parties about his new passive income. It felt amazing. But it was an illusion. The actual underlying math showed he was bleeding cash, paying out of pocket every single month. Now contrast that with Ankit. Ankit relied entirely on disciplined math. He totally ignored the flashy, exciting stories and just put his head down, focusing on the long-term compounding of his portfolio. The result? Ankit ended up with a massively larger corpus. Real math simply doesn't care about FOMO, and it definitely doesn't care about an exciting story.
So that brings us to part four, the value hunter strategy. If we genuinely want to stop trading based on exciting green candles and start trading based on actual solid data, we need a strategy. We need a literal mechanical shield to protect our capital. Which brings us right to hedging. Say you have a long position and you find yourself tossing and turning, worried about a sudden market drop or a crash. You do not follow the panic crowd and sell everything at the absolute bottom. Instead, you learn to hedge. Using put options, for example, is a purely mathematical strategy to protect your investments. Think of it like an insurance policy for your portfolio. It ensures that a sudden, totally unexpected drop doesn't result in a complete wipeout of your capital. You are essentially shielding yourself with math rather than reacting with panic.
There is this fundamental truth to investing that you really just have to let sink in. The market is a machine that transfers money from the impatient to the patient. Let me say that again. It transfers money from the impatient to the patient. If you're just sitting around waiting for the market to get exciting before you decide to invest your money, well, you are already way too late. By the time it's exciting, the impatient are literally just handing their money straight over to the patient investors. You've got to train yourself to be a value hunter, not a momentum chaser.
So I'll leave you with this final kind of provocative thought to chew on. Take a hard look at your own portfolio right now. Are you truly hunting for value before the crowd arrives? Or are you just chasing momentum after the headlines hit? Be honest with yourself. If you found this breakdown of market psychology helpful today, and if you want to protect your friends from buying at the next big market top, go ahead and share this explainer with them. Spread the awareness. Stay tuned for our next analysis, where we'll explore even more ways to master the math of the markets. And as always, go self-made.